Before we start, real quick, if you find financial content that actually challenges what you think you know, hit subscribe. That's what we do here at West Wealth every single week. No fluff, no sponsored nonsense, just the math. Now, I want you to think about the last time someone told you that renting is throwing money away. Your mom said it. Your coworker said it. The bank definitely said it. Here's what none of them told you. Homeowners throw money away too. Every single month. Just with bigger numbers and a fancier name for it. Today we're breaking down the homeownership lie. By the end of this video, you'll know exactly what a mortgage is really costing you, why renting done right can make you genuinely wealthy, and the 4 steps to get there. I'm Wesley. Let's go. Everyone told you the same thing. Your parents, your bank, every ad you've ever seen during a football game. Stop throwing money away on rent. Buy a home. Build equity. That's how you build wealth. And it sounds so obvious, so logical, that almost nobody stops to question it. Almost nobody runs the real numbers. I did. And what I found will make you angry. Or it will save you hundreds of thousands of dollars. Probably both. Let me tell you what the financial industry calls renting. They call it throwing money away. You pay rent, you get nothing back. You own nothing. Here's what they don't tell you. Homeowners throw money away too. Every single month. Except their pile is just way bigger and has a fancier name. Before we talk about the myth, I need you to understand something fundamental. The question is never rent versus own. The real question is, where does your money go and what does it produce? Let's take a real example. You buy a $400,000 home. You put 10% down, that's $40,000. Your mortgage on the remaining $360,000 at 7% interest over 30 years comes out to about $2,395 per month. People look at that and think, not bad. But that's not your real payment. Add property tax, typically 1.2% per year. That's $400 a month. Homeowners insurance, call it $150 a month. Maintenance. Financial planners say budget 1% of home value annually, so another $333 a month. PMI, because you put down less than 20%. Add $180 a month until you've built enough equity. Your real monthly cost? Over $3,450. Not $2,395. $3,450. That $40,000 down payment you spent? Gone. And you're now committed to $3,450 a month, every month, for 30 years. Here's the part that makes people's stomachs drop. Look at your very first mortgage payment of $2,395. How much of that goes toward paying down your loan, toward what people call building equity? $290. The other $2,305, pure interest, straight to the bank. That is not an investment. That is the price of borrowing money. And in the early years of your mortgage, you are almost entirely paying for the privilege of owing your bank a very large amount of money. Amortization is the technical word for this, and it is beautifully designed for the bank. You pay interest-heavy payments first. The principal barely moves. It takes 12 years on a standard mortgage before you're paying more principal than interest each month. 12 years. Let's keep going. Because this is where the real ambush happens. Closing costs when you buy. Plan for 2 to 5% of the purchase price. On a $400,000 home, that's up to $20,000 in fees before you move a single piece of furniture. Loan origination fees, appraisal, title insurance, attorney fees. It adds up fast. Then there's the stuff nobody budgets for. The furnace that fails in January, $6,000. The roof that needs replacing after 20 years, $15,000. The HVAC, the plumbing, the foundation crack, nobody noticed during the inspection. And if you're in an HOA, add $200 to $600 a month in dues plus whatever special assessments they decide to hit you with for the new pool nobody asked for. Then, and this is the one that really stings, when you finally sell, you pay 5 to 6% in realtor commissions. On a home that's now worth $600,000, that's $36,000 gone the moment you sign the papers. Now here's the part where homeowners get defensive. But my house appreciates. It goes up in value. Yes, it does. And we need to talk about what that actually means. The average annual appreciation for U.S. home prices, adjusted for inflation, is about 1% per year. Not 5, not 10. 1%. Robert Shiller, the Nobel Prize-winning economist who literally invented the index that tracks this, has been saying this for decades. Meanwhile, the S&P 500 has returned roughly 10% per year on average over the last century. Even accounting for inflation, that's about 7% real returns. So when your house doubles in value in 20 years, you think you won. But if your down payment had been invested in a diversified index fund, instead, it might have quadrupled. And it didn't cost you $3,450 a month to hold. The house feels like an investment because it's big and visible and emotional. But emotion is not the same as return on investment. Let me show you what actually winning looks like. Sarah rents for $2,000 a month. If she'd bought that equivalent home, she'd be paying $3,450. The difference is $1,450 per month. She takes that $1,450 and invests it every single month into a low-cost index fund. She also invests the $40,000 she didn't tie up in a down payment. After 20 years, assuming a 7% average annual return, Sarah has over $850,000 in liquid, accessible investments. Her portfolio produces income. She can rebalance it, withdraw from it, move it anywhere in the world. The homeowner, they have equity, but equity you can't easily access in an asset that costs money to hold, in a neighborhood they can't leave without a massive transaction cost. Who's richer? By the math, often Sarah. Now, I'm not telling you never to buy. I want to be clear about that. There are real, valid reasons to own a home. If you're in a stable city for the long term, we're talking 10+ years, the math starts to shift. If you have kids and need school districts and stability, that matters. If you genuinely want to renovate and make something your own, ownership gives you that freedom. And if you can buy in cash or with a very large down payment, at a price that means your total monthly cost is close to what rent would be, the calculus changes dramatically. The problem isn't home ownership itself. The problem is the story we tell about it. The story that says renting is always failure and buying is always smart. That story is costing millions of people a fortune. Here's something nobody puts a dollar figure on: your ability to move. We are living through the most significant reshaping of work in a generation. Remote jobs, relocated industries, cities rising and falling. The person who can pick up and move to where the opportunity is, that person has a massive economic advantage. When you own, moving costs you 8 to 10% of your home's value in transaction costs alone. When you rent, moving costs you a security deposit and a U-Haul. That flexibility is worth money, real money. And it is one of the most underrated assets a renter has. So what do you actually do? Here are 4 steps that will change your financial trajectory. Step 1. Rent well below your means. Find a place you can afford for 25% of your take-home pay, not 40%. Yes, it might be smaller. Yes, it might not have granite countertops. Who cares? It's a place to sleep, not a status symbol. Step 2. Invest the difference religiously. This is the non-negotiable part. Take the difference between your rent and what a mortgage would cost and automate it into investments. If rent is $2,000 and a mortgage would be $3,450, that $1,450 goes into an index fund the day you get paid. If you spend it on lifestyle, you lose. If you invest it, you become the millionaire we talked about earlier. Step 3. Build a freedom fund. Instead of saving for a down payment on a house you can't afford, build a liquid portfolio. $20,000 in accessible investments is better than $20,000 locked in equity you can't touch. That cash gives you the power to negotiate, to switch jobs, to say no. Step 4. Run the real numbers. Pull up a spreadsheet tonight. Column A, what you pay in rent plus what you invest with the savings. Column B, the real total monthly cost of owning the equivalent house, mortgage, tax, insurance, maintenance, PMI. Run it forward 10 years, then 20. Watch which column is bigger. That isn't an opinion. That is arithmetic. You are going to feel pressure. Your mom will ask when you're buying. Your coworker will keep showing you their Ring doorbell footage like it's cinema. Let them. You're not playing their game anymore. You're playing the one where you actually win. Winning means having money that moves when you need it to move, instead of money that sits in walls demanding more money to keep existing. The housing market will keep pretending prices make sense. Banks will keep approving mortgages that shouldn't exist. But you're different now. You've seen the math they don't want you to see. Until they're 50 and still making payments on a house that owns them more than they own it. Real wealth is being able to say no to things that look like opportunities but calculate out as traps. You just learned how to say no. Now go use it. I'm Wes. Stay liquid.